My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is the man, the myth, the man behind 42 Macro, Mr. Darius Dale. Darius, introduce yourself to the audience for those who are not familiar with you. Who are you? What's your background? How'd you get involved in markets? And why 42 Macro?
Why 42 Macro? So appreciate everyone for joining us. This is always a pleasure to connect with the audience. Michael, I think you do phenomenal work. Keep up the good work, my friend. But anyway, everyone, I'm Darius Dale. I'm the founder and CEO and chief plumber, chief lunch maker, chief internet technician of 42 Macro. We're a small but growing investment research shop focused on, I'm going to steal a line from my buddy Adam Taggart, who I recorded with yesterday. We're really focused on narrowing that asymmetry between the informational advantage that top institutions on Wall Street have, many of whom are my clients, and regular investors like many of you on this spaces.
Okay, so let's go right to the heart of the matter. So I know you want to focus on liquidity and where we are in terms of the business cycle. First of all, let's define for the audience what the hell liquidity is. That's a term that's thrown around a lot. I'm not sure if people really understand what liquidity in practice means. So let's go basic. What is liquidity and why does it matter?
It's two things. So I'll start with the kind of quantitative technical definition of liquidity, which is how easy it is to get, to sort of get in and out of positions without, kind of crossing the bid or offer or the midpoint of the price in the market. And the reason we care so much about the kind of liquidity that you're all here to hear about is because that kind of liquidity makes it very easy for that process to occur. And moreover, not only does it make it very easy for that process to occur, it makes it very easy for investors to sustain higher and higher prices because they have more and more capital, cash, however you want to call it, to leverage, if you're working at a leveraged financial institution, to sustain those prices and buy at higher prices. I mean, these high prices don't just come out of nowhere. The money needs to be there to support the high prices. And so when we think about this kind of, esoteric, squishy concept of liquidity, I think it's very important to kind of differentiate between private sector liquidity and public sector liquidity. That's something we do very specifically and religiously there at 42 Macro. On the public sector side, clearly central bank balance sheets and the amount of liquidity that is effectively coming from central bank balance sheets. Some likes to focus on reserves. We obviously have our own metric that's quite popular. I'm sure everyone knows it, so I don't need to repeat it in terms of the amount of liquidity that's coming from the public sector. And we can obviously net out the confluence between the Fed and Treasury, or the Fed and Treasury counterparts in other economies. So that's sort of public sector liquidity. The private sector liquidity and the liquidity we've all been trained to focus on over the last kind of 6 weeks or so, or many of you, this is something we look at all the time, but many of us have been trained to focus on over the past 6 weeks or so, is the concept of public sector liquidity. This is money in the real economy that allows either real households or financial institutions to lever up and buy capital assets, whether they be stocks, credits, or houses or cars. And that liquidity is usually a function of how much risk taking, risk appetite, and regulation is kind of hitting the banking sector at any given moment. So we can unpack any of those avenues of liquidity to kind of give you a sense of what's happening in real time, what's been happening, and what's likely to happen on a go-forward basis.
Yeah, and I think the key thing is that there's almost differences of liquidity seemingly daily. So I'm with you. I saw the Bitcoin movement, the entire crypto space movement, and then the round trip that happened very quickly. I think there's a difference between liquidity and then frictionless trading, right? So money sloshing around is different than the ease with which it's moving, because it's just easier, right, to trade in and out of different areas, especially commission free in today's world. Where are we in the liquidity cycle for the private sector? So I see all the same things probably that you do, which is that it's cliche, but there's a lot of money on the sidelines, even though money supply has been dropping. Where are we on this liquidity cycle for the public and private side?
So great question, my friend. And spoiler alert. And so before we even answer the question, I did want to clarify. The reason I brought the point about liquidity, market liquidity, is because you tend to have adverse market liquidity when actual liquidity, the liquidity we care about because it leads the market liquidity, is poor. And vice versa, you have positive market liquidity. It's very easy to get in and out of positions and very easy to levitate markets at higher and higher prices because liquidity is abundant and plentiful and everyone's got access to it. So that's why we care about that. That's why I started there, because ultimately we need to relate this stuff back to prices. At the end of the day, we can't buy central bank balance sheets or M1. What we're trying to do is buy assets and profit from the financial markets. So that's why I started there. But I see your point, my friend. So in terms of where we are with the private sector liquidity, I assume you are talking about the United States of America. I don't know too much about Filipino liquidity, but it is what it is. So right now, we're very clearly in a liquidity cycle downturn. Have been for several quarters now. It's obviously gotten worse. So we'll start, if you just look at deposits at commercial banks here in America. They're contracting at around. They're actually on a max drawdown basis, right around down 5.4%. That's one of the sharpest contractions we have ever seen in this time series, with data going all the way back to 1973. So, we clearly have some problems in our hands as it relates to private sector liquidity. How we track private sector liquidity specifically is through the lens of narrow money supply, or M1 money supply. That's the monetary base, which is bank reserves and coins in circulation, plus all the demand deposits in the economy. What we really care about is the demand deposit function, but it's overwhelming feature of that calculation. And M1 in the U.S. economy is currently drawing down at minus 8.3% on a max drawdown basis. And it's actually 8.3% on a year-over-year basis as well. I think it peaked in March of 2022. And so that 8.3% is the sharpest max drawdown in M1, or a narrow money supply, in the history of the U.S. economy. And this data goes all the way back to the late 1950s. So we very clearly have a destruction of private sector liquidity that is coinciding with the destruction of public sector liquidity, specifically here in the U.S. And obviously, folks are familiar with our 42 macro net liquidity model. We've since adjusted that model to counteract the nonsensical claim that emergency lending on the Fed's balance sheet, as we learned today in Bitcoin land, is an actual act of liquidity, is an actual supply of real liquidity to the market, or what we consider to be unencumbered liquidity that can be used to speculate in financial assets. And so how that calculation goes, for those of you who've been sleeping under the world's most comfortable rock, it's the Fed's balance sheet minus the Treasury general account balance, minus the reverse repo facility balance, minus the the emergency lending, again on the Fed's balance sheet. Those sum totals, and that is our approximation of how much sort of money that is actually being kind of created by the Fed's balance sheet, that is able to be sloshed around the financial sector, both through banks and non-bank lenders, in order to create leverage in the system, capped by securitized products, loans of high yield credit, or et cetera, loans of houses, or whatever they may be, that makes the financial sector kind of tick and prices go up. And so that liquidity has obviously been in a downtrend. The steepest part of the slope of the downtrend was very much kind of coinciding with the first 3 quarters of 2023. And since then, we're still kind of in a narrow downtrend, but the slope is really kind of flattened out really since kind of September, October of last year. We are close to the lows, however, and I do believe that the markets, if you look at where the price of the S&P, price of Bitcoin, price of Ethereum, kind of your kind of main proxies for risk assets here, those prices are very disconnected from where adjusted net liquidity is. So I would expect to see something that looks like a correction over the next, call it 1 to 2 months. But that doesn't necessarily mean we're ready for the big main event that I see coming in the second half of the year.
So it sounds like you and I are probably of the similar mindset that there's a credit event looming, which would be sort of the main event. But I want to go back to this point about liquidity in the context of credit spreads, right? So usually when you have a lot of liquidity, spreads are narrow. Usually when you don't have that much liquidity, credit spreads widen, default risk premiums increase. And I'm with you on all this. And this has been one of the more perplexing aspects of the bond market. But if the bond market is also a discounting mechanism, why isn't it the case that high yield credit spreads haven't blown out as liquidity has worsened across the board?
So they have blown out. I mean, we're certainly not on the lows anymore. We're down at 200-300 basis points a couple of years ago, and we're now at around 450 basis points. So they have blown out with this kind of destruction of private sector liquidity. We did see a pretty significant uptick in global liquidity that obviously, across markets, money is fungible. And obviously we have the world's largest and deepest capital markets. So a lot of that global money that was being created, particularly on the public sector side, really, I assume, found its way in our markets. I mean, we can sort of infer that just by market performance and the correlations between, these various measures of global liquidity. And in terms of how we calculate global liquidity, specifically, through this kind of public sector, private sector format, we look at the global central bank balance sheet, we amalgamate that in dollar terms. I don't think that's the most accurate way to do it, but it's probably the easiest and it's the simplest way to do it. And the correlations that very much hold. So it's, I don't know that we need to kind of boil the ocean to make a better product, although I'm in the process of experimenting with different models, but that's neither here nor there for this discussion. So we have the world central bank balance sheet. This would be kind of our proxy for the global adjusted net liquidity model. Although again, not quite the same, but at least the proxy. We have world narrow money supply. So we're amalgamating that across all the major economies. That's currently at 52.2 trillion right now. Sorry, let me go back and throw some numbers on the world central bank balance sheet. So the world central bank balance sheet is currently at $30.2 trillion. If you look at it on a trailing 3-month basis, at the lows of September of last year, on a trailing 3-month basis, that figure had declined minus $2 trillion. At the highs of January 2023, on a trailing 3-month basis, the trailing 3-month momentum in the time series was plus $1.4 trillion. So we had a pretty significant, basically a $3.5 trillion swing in the kind of the impulse of global liquidity on a trend basis, kind of from the lows of late Q3, early Q4 to the highs of early Q1 of 2023. Well, the trailing 3-month impulse, as of the most recent data through March, is minus $332 billion. So we now have a negative global liquidity impulse from the perspective of world public sector liquidity. So I'm not too sure that people are acknowledging that, but certainly this is something we track daily here in our research at 42 Macro. With respect to world narrow money supply, that figure is $52.2 trillion. And at the lows of October of last year, world narrow money supply was contracting minus $2.7 trillion on a trailing 3-month momentum basis, on a trailing 3-month impulse basis. At the highs of January of this year, so really Q1, the global liquidity was plus $2.2 trillion on a trailing 3-month basis. So we had basically a $4 to $5 trillion swing in a matter of 4 months in world narrow money supply on an impulse basis. Markets function on rate of change, not levels. So the rate of change of that plus 5 was pretty significant in terms of helping resuscitate, helping assets counteract what is very clearly and obviously what we've been calling a phase 1 liquidity cycle downturn, at least here in the U.S., which is the Fed tightening us into a slowdown, which ultimately will result in a phase 2 credit cycle downturn. So part of the reason we have not seen that phase 2 process play out is twofold. One, we've seen a kind of a wave of global liquidity kind of spill out and over and into the system that really, kind of help fight that process. But two, it's something we've been arguing since July, which is the U.S. economy is very resilient for a variety of different factors. And, we can go into a myriad of those factors, but the U.S. economy is resilient and asset markets aren't particularly forward looking. And I can say that with a great degree of sort of ethos when I make that statement, because I do believe, certainly on the sell side, that I think I've personally back tested asset markets better than anyone in the world in terms of that, putting out academic research on that kind of subject. So that what I found in all of my back testing processes and models is that, markets don't tend to be more than 1 to 2 months forward looking. If you relate the rate of change of impulses in growth, impulses in inflation, impulses in liquidity back to impulses in the market, there's really no correlation at all when you go beyond 2 to 3 months. And so all of the correlation tends to be in kind of the 1 to 2 month, at most 3-month time frame. So, our view is that the U.S. economy was likely to remain resilient really through to towards the end of 2023. And as a function of that, we don't really have to price in the big bang that you and I both see coming, Michael, until, we get to, kind of, let's say Q3, maybe even early Q4.
I think it's important to distinguish which market, though, right? Because you've got a tale of two very different markets that are responding to liquidity in different ways. You've got, large caps, largely tech, right, holding up, I think, fairly well, while, small caps in particular, granted that's because of the sort of co-movement around regional banks, have gotten just obliterated from, their highs of the year. Is there anything in your studies that would suggest that liquidity is more important to small caps as opposed to large cap?
Yeah. So it's very clearly when the liquidity cycle is positive. So when you have positive impulses on these metrics, and oh, by the way, I forgot one number, going back to the world narrow money supply. I remember you said it peaked at plus 2.2 trillion on a 3-month impulse basis in January. That number is now minus 982 billion on a trailing 3-month impulse basis through March. So, we've had this pretty subsiding shift in both, world public sector liquidity and global private sector liquidity. Going back to your question on small caps, the answer is yes. So when the impulse is positive from the liquidity perspective, and you pick your liquidity indicator, you're going to get to the same conclusion. When the impulse is positive, you tend to have positive appreciation or positive price momentum in sort of more pro-cyclical sectors and style factors on a relative dispersion basis to defensive sectors and style factors. You tend to see small caps outperform mega caps. You tend to see value outperform growth. You tend to see high yield credit outperform investment grade credit, both on a spread and price appreciation basis. And so, liquidity does matter. It's not the only thing that matters. I think people spend too much time on Twitter. They all kind of coalesce around one factor because it's working at a particular time, and then eventually the factor will stop working, and they're going to need to find some other factor. So this is why we do a compendium of analysis to sort of understand what is actually driving asset markets at any given time, and then ultimately have informed opinions about that, vis-a-vis our forecasting tools on growth, inflation, employment cycle, et cetera.
Okay, now I'm going to assume, maybe I'm wrong, that in pre-election years, on average, liquidity tends to rise. That's one of the reasons why pre-election years, on average, tend to be the strongest of the 4-year presidential cycle. I've made this point before that I think we're in kind of a broader melt-up environment, but that you could still have some kind of tail event out there. And some people, when I've made this argument around a correction short term, but still within the context of broader melt up, and then using your words, kind of a main event, they think I'm asking for too much to happen in 1 year. And I always go back to in 1987, you had the Dow up 38% at its peak prior to the crash of 87. Then you had the crash of 87. Then you had a Fed pivot. So there is some parallel, right? Not necessarily have to have a crash like October 87, but you can have that kind of sequence all happen in a very compressed 12-month period. Am I off on the idea that we could see something wild like that really surprises a lot of people? So you got these kind of short-term, potential correction risks. Then everybody gets screwed getting bearish at the wrong time. Markets have a run higher, and then comes a big event. Let's talk about the sequence that you're seeing.
Yeah, no, I mean, it's kind of in our base case scenario. I think that price level was somewhere around 43 to 4,200. That's kind of like the price level we've thought to be the suck everyone back in price. And we've seen this a couple of times, right? We saw it in August. We saw it in the early February. But by the way, we faded both of those movements. It was pretty hard to fade in both of those times, but it was obviously rewarded for fading both of those rallies. But we've been of the view that markets are going to have a very difficult time in this kind of post midterm election process, because again, that's what Michael. I'm glad you called that out. It is the most bullish backtest in the history of backtests. I've never seen in all my years in quantitative, economics and finance for the past 14 years of building models and studying things and all this 6 ways to Sunday. I've never seen anything like this. If you look at the midterm election cycle, I want to say going back to the how many midterm elections we've had since 1946, on a median basis, the S&P 500 is up 16% on a 12-month forward basis, with an interquartile range of +9 to +21. Like, there's hardly any negative outcomes. 80%, 89% of the outcomes are positive on that interquartile range of +9 to +21. So I've never seen anything like this in my life. So as bears, we are fighting some serious kind of like voodoo. I don't really know how else to describe it, but it is voodoo. But I will say there's only 2 instances in the sample, which again goes all the way back to the 1946 midterm election. There's only 2 instances in the sample that occurred where the midterm election occurred during a bear market. And in 1946, the S&P was down 2%, 12-month forward. And in November 8, 2018, the S&P was up 14%, 12 months forward. So it's kind of a coin toss in terms of that. But just going back into answering your question on kind of how do I see the sequence of events playing out, as I mentioned, our models don't suggest that a recession is a high probability outcome until you get into the latter part of the year. We have about 6 or 7 different models that we use to kind of pinpoint with fairly precise accuracy when a recession is most likely to commence, and the modal outcome from those models is Q4. There's a little bit of a tail towards Q3, and there's slightly more of a tail towards Q1 of next year, but the modal outcome of that distribution is Q4. And so going back to everything I said about market performance and not being particularly forward looking, I don't expect markets to really care about that until we get into Q3 of this year, or, maybe even, Q4, maybe even early Q4. And so I do believe, to the point you're making, I think it's very easily markets can continue to chop around or even try to suck you in. Let's say the market sniffs past 4,300 later this year, let's say in kind of the midsummer, early summer. Who knows? Maybe we can get there. I'm not saying I have a crystal ball on what that ultimate level will be from the which point the phase two credit cycle downturn commences. All I'm trying to say is that it's probably going to commence, and you're probably not going to want to be long risk assets, in that time period heading into that event. But it's April 26th, and so I don't think you have to particularly worry about a big market crash now. I think you have at least a few more months to play fun and games on the Bitcoin chart, like we've seen today.
So people hearing this would probably say, well, I guess if we're in this kind of environment where you can see some big swings, this must be a great environment for traders as opposed to those that position. Listen, as much as I myself have gotten a lot of these kind of moves, I think with hindsight, from a condition standpoint, largely right, this sequence has been brutal. You can be right about a regional bank crisis, but if you're off by 1 week and you happen to be in small caps or out of small caps, it's almost like that's the entire year, right? Given the way that these things are moving. How do you think about sort of somebody putting money to work here? Should they be having more of a trader mindset, or are there certain asset classes, maybe gold, maybe Bitcoin itself, where independent of what happens this year, it's going to be on its own track?
So great question. I'll answer that in two ways. One, if you're a retail investor, I say this all the time to our retail investor clients. And by the way, all of our clients at 42 Macro receive all the same information. We don't give super sophisticated presentations to our super sophisticated hedge funds and just assume that our retail investor clients can't learn and benefit from that information. So everyone sees the same thing. Everyone gets the same trade ideas. Everyone gets the same portfolio construction guidance. So, but I do give them just more behavioral guidance that it's a little bit different. If you're a retail investor and you're in the middle of a bear market, what the hell are you doing? I mean, seriously, like what? You don't have to participate. I mean, Wall Street's whole marketing message is to convince you that you always have to participate so that they're always collecting fees on your products. And I don't mean that, obviously to disparage you, Michael, obviously you're running a business here, but
You're
my
100% right. My approach is a whole different animal. It's rotational in nature, not designed to be constantly in one asset class. Which, I mean, that's the frustrating part about last year. It's like treasuries and equities acted the same, right? But you're 100% right. I mean, and there is an incentive because everybody that's running a fund gets a fee every single day that's accrued, trying to keep somebody in. And yes, there's a lot of research around time in the market matters more than time out of the market, but the thing with all these studies around time in the market versus time out of the market is that it's missing the discussion around volatility clustering. I mean, that's a whole other dynamic. But anyway, sorry,
it's missing the whole discussion around volatility drag too. What happens when you put a bunch of money to work and it gets cut in half immediately? They don't teach you that in business school, but you learn that real quick when you start trading. You learn that real quick on the buy side.
100%.
Half the people in this room, no offense, they have no idea what volatility drag is. I encourage everyone to Google that and spend at least 5 minutes this night, just kind of understanding, familiarizing yourself with the concept. It's one of the least talked about aspects of finance, but it's arguably the most important, in my opinion. But anyway, kind of getting back to this discussion on investing, with respect to retail investors, I mean, obviously we're not like overly concerned about a big market crash here in April. I do believe we're probably going to be very overly concerned, certainly by the time we get towards the end of Q3. Between now and then, I mean, sure, go out and do what you got to do if you need to be long Bitcoin or Ethereum, or you just can't not buy Meta or Apple, or I don't know what these companies are doing these days. But my key takeaway is why? What are you doing? Here's what you need to do in a bear market, or what I think you should be doing in a bear market. Clearly keeping your strategic investment objectives in line with this comment, which is make a ton of money in bull markets. Don't lose a ton of money in bear markets. That's literally it. Like as a retail investor, that's literally it. If you're trying to do more than that, it's because you convinced yourself you're smarter than the market. You're smarter than all these brilliant people spending billions, and not M with the M, not M as in Mary, B as in Bill, billions of dollars on research and trading and all these other resources that are giving them slight edges, to transact on a day-to-day, week-to-week, month-to-month basis. You're not going to beat them at this game of generating return all the time. You're never going to beat them at this game. I figured that out the hard way, after 18 months of 42 Macro, and we switched to a systematic portfolio construction process that removed my, kind of a quote, I'm air quoting right now, to remove my intelligence with air quotes out of that equation. And so that's my key takeaway for retail investors is If it's not a bull market, you shouldn't be participating too much because your goal is to make a ton of money in bull markets and put that money away in a bear market until you're getting close to a bull market again. If you're doing something more than that as a retail investor, it's again, you've convinced yourself you're smarter than Jim Simons and you're not. If you're a professional investor, and obviously we have a decent number of professional investor clients as well, our client base is actually quite split down the middle, to be honest, at the unit level. If you're a professional investor, obviously your job is to compound returns and not get, not have big drawdowns and not get fired, not lose the seat you're sitting in. And that is hell. And it's like the worst kind of hell in the past kind of year. Because in my opinion, the bear market was really easy, from let's call it, late Q4 of 2021 to, I would say June of 2022. It's been very difficult kind of since then because we've been basically bouncing around in the most violent manner possible between, I'm just going to throw, random numbers out there. Let's call it, say, 4,200 on the top side and 3,800 on the bottom side. Obviously, we got to like 4,300 in August. We got to 3,500 in October. But by and large, we've been basically violently whipping around, in this kind of 400 to 500 point range in the S&P for a while. And not only have we been violently whipping around in price terms, we've been even more violently whipping around in sector and style factor dispersion terms. And so that, I think, has made it an incredibly challenging environment for trend following strategies to work, for market neutral strategies to work, just general hedge fund, your traditional hedge fund strategies to work. And it's been very, very volatile and very violent. I mean, it's been very difficult. I can't express enough to you how many annual returns we've had in the past year. I mean, we've had plus 10, down 15, plus 20, down 12, plus 15. I mean, we have like 6 or 7 years worth of returns in like the last year. And so it's made it very difficult for most investors to risk manage. Obviously, there's been a lot of turnover on the buy side as a function of that. And I don't really see us breaking out of that. And the reason for us not to really materially break out of that or below that is because, again, on the bounce side, we don't have the phase 2 credit cycle downturn to price in until we get to, let's say 1, 2, 3 months ahead of it. And on the top side, we still are dealing with this resilient U.S. economy that is contributing to some very real resilient U.S. inflation. And that resilient U.S. inflation, if you look at it on our score, we're still compounding at 4.8% on a 3-month annualized basis for core PCE. If you want to strip out all the stuff that consumers care about and sleep in and eat and all that good stuff, super core PCE is compounding at 4.3% 3-month annualized. Median CPI at 6.8%, trim mean CPI at 5.8%. Why do I use these statistics? Well, these are the most underlying core dressed down versions of inflation that you could possibly get to kind of see what the real underlying truth and price changes are. And the reality is we still 2 to 3x the Fed's, price stability target in a lot of these metrics and are going to remain, at least 2x in terms of the Fed's 2% price stability target until we get into and through recession. There is no history in any time series of core inflation breaking down considerably before a recession. None. So we got to go through the soup if the Fed wants to achieve its objective.
By the way, you blew my mind saying that these anonymous FinTwit accounts are not better than Jim Simons. I think that was really mind blowing to me. No, I'll tell you what. I say that jokingly, but I'm not joking. It's like this is the insanity of FinTwit and Twitter. It's like part of my language. Fucking people, are you kidding me? Like, you're exactly right. There are people that are throwing significant dollars at trying to identify anomalies, trying to figure out what happens next to markets. You think some anonymous account that's sharing some bear porn or bull porn, it really knows what's going to happen next? We're all coming from the same point of view. Nobody can predict the future. There's a lot of money that's trying to figure out the signals that get you to the future, but I don't know, man. It's just this whole Fintwick community thing. It drives me bonkers the way that people seem to think that they have special knowledge when there are literally billions of dollars trying to figure out how the market works.
Yeah, no, and I would characterize it a different way. I'm glad that we have so many people participating and getting empowered and figuring out what the hell to do with their money, because I think we also figured out over the course of time. Obviously, one of my investing idols figured this out and published a book about it, which is the professionals don't know what the hell they're doing half the time either. Let's be totally honest. I get a lot of stuff wrong. I got my face ripped off in the second half of last year. It was brutal. That was probably the worst period of performance in my 14-year career. just getting whipped around last year, towards the end of last year. It was tough. So we got to all be humble about this whole process, no matter where you are on that kind of, S curve of knowledge and ability with respect to trading, with respect to investing, with respect to managing your own behavioral biases. No matter where you are on those S curves, you still have to acknowledge the fact that it's a damn steep S curve, and just be humble about it and try to do the best you can with the tools that you have, with the tools that you can access and purchase, from guys like myself or Michael or anyone else.
Speaking about getting whipped around, I'd argue that one part of the marketplace which has not been whipped around as much and has been, for the most part, pretty consistent in the trend and in the message is what you had, I think, retweeted with a comment, which is my focus on lumber, right? Which just has been getting utterly obliterated. This weakness in lumber, I keep stressing, to me is a real big concern. And a lot of people will argue that, well, but look at the home building stocks, right? They keep on acting strong. Lumber, who cares? It's about the home building stocks. I have not seen any real evidence that suggests that home building equities have predictive power. I have seen evidence that lumber has predictive power because I put a paper out about it. I'm curious to hear your thoughts on housing in the context of all this, because if we're going to be talking about liquidity, we're going to be talking about credit availability. You have to definitely hit on the number one asset for most people, which is their homes.
Yeah, absolutely. I actually wrote a note about that this morning. Housing is it's unfortunately booming again. I know that's not the conclusion people were expecting to hear, but it's the truth, and it won't remain the truth because again we're headed for an unemployment cycle, so it's not going to remain the truth. But in this hyper financialized U.S. economy, where the speed of particularly the non-bank financial sector, which dominates residential lending, that they're lending loans and getting people to close housing deals. I mean, we can see it. I'll just rattle off some numbers. So we track kind of 5 statistics in housing. We track a bunch of statistics in housing, but kind of like our main dashboard, kind of just like it progresses in terms of in terms of lead to lag. But permits are up 27.8% on a 3-month annualized basis. Housing starts up 21.4% on a 3-month annualized basis. Pending home sales up 41% 3-month annualized. Existing home sales up 41% 3-month annualized. New home sales up 39% 3-month annualized. Now, these numbers are like not even in the area code of their long-term averages. And so, we're definitely seeing markets respond to positive equity performance that creates risk-taking or more risk-taking ability, or at least the minimum, the desire to take more risk in the shadow banking sector and the non-bank financial sectors creates the desire for everyone to take more risk. You see a chart of the S&P or Bitcoin up, you want to take more risk. That's how this stuff works. Behavior. But also as a factor is obviously we saw interest rates decline, to the extent, we've seen interest rates decline, we're seeing unemployment hang in. And so as a function of those two things, in the context, again, of this hyper-financialized U.S. economy, we are seeing just more activity in that space. And I keep saying hyper-financialized. What I mean by that is, we are impressively banked, and more importantly, we are impressively banked by non-bank, market participants. We have a private non-financial sector debt burden of right around 155% of GDP in the U.S., and only 33% of that, 155% of GDP comes from actual banks like Silicon Valley Bank, First Republic Bank, Bank of America, et cetera. The rest of it comes from the non-bank non-bank lenders, so mortgage brokers, what else? Hedge funds, credit funds, mutual funds, pension funds, insurance funds, all these other entities that create credit, whether they be buying securitized products, loans that banks originated, et cetera. But, the system works really quickly now because those agents are much more responsive to market conditions than traditional banks, which are much more responsive to, their availability and cost of capital.
But it's interesting. So okay, let's go with that. So housing looks like it's accelerating. Yeah, if housing's strong, you'd expect consumer sentiment's going to be strong, right? Consumer spending is going to be strong. This is what I'm talking about. We're in this kind of weird environment where there's a lot of disconnects. Lumber's saying one thing, home builders stocks are saying another. To your point, some of the housing data is obviously looking quite strong. So what's to worry about? At the same time, if housing is strong, one would think that consumer discretionary stocks would be outperforming the S&P 500. Not the case, right? It's still breaking down. Retailers against the S&P 500, new relative low. I think it looks like as of today, you're back to kind of the 2020 July levels of retailers relative to equities. So my point is that there seems to be a disconnect, right? If housing is not going to break down, and if the housing data is starting to reaccelerate and pick up, it's happening and leaving the areas which are most sensitive to the wealth effects consumers behind, right? And I think that becomes problematic from a signaling perspective.
Yeah, I completely agree. And by the way, when I think we got to define, just for the sake of the audience, like what we mean when we say strong, weak, et cetera, et cetera. Pretty much everything that comes out of my mouth is in rate of change terms, is in delta terms. Is it getting better or worse? Not necessarily is it good or bad. We're up 41% in new home sale or in existing home sales from a very low base. So it's still bad in absolute terms. So housing is technically bad. It's just very, very strong. It's booming in delta terms. So that's that. I think that's an important distinction. And the reason we look at information this way is because, one, the markets care about this. I've backtested. This is one of the many things I've backtested and studied throughout my career. Markets care about the rate of change and the direction of travel of information more than they care about the level of information. I would argue markets don't really care about the level of information at all. I mean, there's hardly any statistical study you can perform to get to that conclusion. So that's why we focus on the rate of change. But also, we focus on the rate of change because everyone else focuses on the rate of change. Many buy-side clients, across the world who all do various forms of what we're doing, or, whether it be on the macro side or the fixed income side, and, maybe even on the equity, strategy side, everyone kind of cares about the same stuff. So what we're trying to do is make sure we can front run what the other guy's thinking, other gals going to do. So it's part, understanding that this is what matters both to markets, but also this is what matters to other people who are market participants in the market. So that's kind of how we think about things in rate of change terms. So I just want to make sure that's a very important distinction whenever we're having these conversations, because people can get lost.
Yeah, no, that's very good. So I found the tweet that you retweeted with comment with a great video you put out, and I love the respect the x-axis hashtag. By the way,
Oh yeah, my favorite.
It's I'd love to see that trending, but oftentimes I see butts trending on Twitter, not respect the x-axis. And I've been told that's actual that's politician. That's not I don't think that's actually. Anyway, first of all, let's get into that a little bit for the audience, and I don't think it's news to anybody because this chart has been out there quite a bit. I've replicated it in different ways, but everyone keeps on saying, still in the traditional media, we need the Fed to pivot for markets to go higher. We need lower rates for markets to go higher. You and I both know there's a lot more nuance to that. So lay out the whole argument for how the market historically reacts to Fed pivots, and in the context of whether you're in a bear market or bull market, what's the response?
Yeah, great call. Great question. So I'm glad you gave that context, because, I saw that your study highlighted a series of Fed pivots in all market scenarios. I want to say dating back to either was it the 70s or the late 60s or something like that.
On the
which is accurate. I think the 61. Yeah, exactly. And I think the conclusion of your study is very much accurate, which is, on balance, when the Fed pivots from a tightening scenario, it's usually not good. And I followed up to chime in to say, but my friend, when the Fed pivots in a bear market as a conditional filter, it actually tends to be very good. In fact, it tends to bottom the market. And so we performed a big statistical study last summer, kind of at the height of the initial, will they pivot, discussion that dates back to all the 17 bear markets that we've had from an all-time high in the S&P 500, dating back to Act 1 of the Great Depression. And there have been, again, there have been 17 with the median drawdown of minus 28%. And when we looked at, the date of the Fed pivot relative to the date of the actual market bottom, then we found some pretty interesting conclusions. And by the way, in terms of how the study was conducted, there were three styles of Fed pivot that we observed in the analysis. There was the obvious pivot, they were hiking and then they start cutting. There's the pause pivot, which is they're hiking and they don't do anything for at least 6 months. And then there's the panic pivot, which is they were already cutting and then something bad happens and they start cutting much faster at bigger clips. It's kind of what we saw in 2020. So there's three styles of pivots, but the one thing that was very consistent across the analysis, which is the market tends to bottom right around when they pivot. In fact, on a median basis, and again, we're looking at 17 bear markets. In fact, there's only 15 actually in the actual conclusion, because we couldn't ascertain pivots for the 46 to 47 bear market, nor could we ascertain pivots for the 48 to 49 bear market. But the other 15 in the sample, we could. And on a median basis, the market tends to had bottomed just 1 month after that inflection in the Fed liquidity cycle, going from pause to pivot to panic. So that was pretty instructive. But I think what was also instructive is the narrowness of the interquartile range. I mean, the interquartile range is on the third quartile, the market bottoms coincident with the Fed pivot. And on the first quartile, the market bottoms only 3 months after the Fed pivot. And so that, to me, that was pretty instructive. Obviously, there's some outlier outcomes in the sample. If you look at, 2007, 2009, the market bottom 18 months after the Fed pivoted. 2000 to 2002, the market bottomed 21 months after the Fed pivot. And in 1980, 1982 bear market, the market bottomed 14 months after the Fed pivot. But those are the only three outcomes in the entire 15 bear market sample where there was a meaningful, kind of delay with to the market outcome. So, obviously anything could happen when you look at it on a go forward basis. But obviously the number one rule of investing is trying to assess probabilities and reassess probabilities and putting yourself in the highest probability outcomes on a kind of on a rolling basis as a Bayesian. We don't want to put ourselves in the lowest probability outcomes. Anything could happen. What's the point of doing research if you're going to skew your decision making towards the lowest probability outcomes? That's obviously not rational. So one final thing I'll say about this study is that the max value in the study is +2, which means that the market at most bottomed 2 months before the Fed pivot. And this was during the 1937, 1942 bear market. That scares me, and it should scare everyone listening to this, because I don't really believe in the invest according to a study or a sample making a new 0th percentile or 100th percentile reading, which is, data geek way of saying this time is not different. And so I don't invest according to this time is different. I invest according to the highest probability outcome is that it's going to be somewhere within this bounded range of outcomes. And so if 2 is likely to still be the max variable or value in this equation, then it would seem to suggest that October of 2022 was not the ultimate low of the bear market, because obviously October 2022 was not 2 months ahead of the Fed pivot. And so that to me is quite concerning if you believe in the bull case. And I know I'm not fighting the bull case between now and let's say late Q3, but if you're really a big believer that the market already bottomed, then this is spring of 2020. Which, by the way, I was bullish then. I got into a big fight with my former boss for being bullish back then. If you think this is spring of 2020, you got another thing coming, unfortunately.
By the way, I'm of the same mindset I shared in the Nest. That chart that I've showed that thankfully got like 10 million views over the last 4 or 5 months, showing the interaction of treasuries against equities and a major drawdown for equities. Basically the idea is, you look at the top 20 biggest declines, peak to trough, treasuries 10 out of 20 times make money, long duration treasuries, while equities are going down heavy. 9 out of 20 times they lose, but they lose a lot less. Last year was the only time in history that treasuries lost more money than stocks in a major drawdown for stocks. But the assumption in the idea that treasuries failed as the quote unquote safe haven throughout the drawdown is that the drawdown for stocks is over. So to your point, if we were to break the lows, which I think would happen under a credit event type of scenario, that's the whole sequence path I myself have been arguing, it could very well be that we look back and that top 20 drawdown chart shows actually that treasuries on a relative basis were still a better allocation. Right? In other words, if you have another wave lower and treasuries counter this time, well, that could be enough to cause the totality of the drawdown on equities to look like 1968 to 1970, where treasuries were down 14% while the S&P was down peak to trough 33 or so, right? So this is the thing about these sort of definitions around bear markets and bull markets. It's all said with hindsight, right? It's like nobody really knows if we're in a bull market or in a bear market. You can only say we're in a bull market after you've probably already taken out the prior real highs, not the nominal highs, right? The real S&P adjusted highs. Until then, I still think we're in a bear market, regardless of a melt up type of scenario that can maybe push you to nominal highs for a moment in time.
37 to 42, I said a few minutes ago. 37 to 42. That's 1937 to 1942. Do you know how people would lose their damn minds if they can't buy Apple for 5 years? They will lose their minds, So this is the point I'm making. You're absolutely spot on. There's plenty of time series history of multi-year bear markets and bonds correlating and uncorrelating, and actually do provide that diversifier. By the way, we are very much in your camp. We do expect phase 2 credit cycle downturn to be the part of the bear market where the bonds actually, perform that function in the in your portfolio, perform that, defensive function in your portfolio. And the reason for this is because we think we're heading into recession. If this, there have been plenty of bear markets that are not associated with recession. It's roughly around. It's actually there are plenty of bear markets, but there's way more bear markets than the ones we discussed in our sample. The ones we discussed in our sample were bear markets from a prior all-time high on a nominal basis in the S&P 500. There are other bear markets within those bear markets. Like that bear market I discussed in 1937 to 42 probably had like 5 or 6 bear markets in it if you just count like a 20% drawdown from a local high as a bear market. But we don't consider that because it's obviously contained within that bigger one. And we've had bear markets within this bear market and bull markets within this bear market, but that aren't really true bull markets, right? So I just, again, we can argue about this stuff 6 ways to Sunday. I think we're kind of arguing nomenclature, and I think we'll lose the audience if we keep going down this rabbit hole. But one thing I will say on going down to the bond point, a lot of folks are sort of like, yeah, but like bonds have kind of rallied. Inflation's going to be high in this decade. So, what's the value on a 3.5%, 10-year piece of paper from here? And, I'm very sympathetic to that view. I think we have one of the more sophisticated dynamic factor models that projects, the longer run, trend of inflation. I've had this model vetted by all the top institutions across Wall Street. And so, I think it holds its chops. And, that model does agree with the general consensus that inflation is going to be high and sticky in this decade, or at least over the, longer term forecast horizon. But from a cyclical standpoint, the bond market, the money markets haven't priced in enough easing to, in terms of what's likely to happen in the economy over the next 12 to 18 months. Specifically, if you look at, the Fed funds rate floor through the lens of the OIS market, the option overnight index swap market, which is, tracks the Fed funds rate, that's only pricing in right around, let's call it 250 basis points of cuts. And on a median basis during recession, the Fed tends to cut right around 400 basis points. So basically 175 to 150 basis points more than what is currently priced in. And then if you look at it, you sort of, Windsor-wise that sample down to just the recessions that occur due to Fed tightening, due to monetary tightening. There's the median rate cut in cycle in that process is minus 475 basis points. So you could tack on another 175 basis points. So you're talking about the market's either not underpricing a recession by 150 basis points, or it's underpricing a recession by 225 basis points, relative to previous cycles, relative to previous, credit cycle downturns. And so in our view, from a cyclical perspective, bonds represent a lot of value because they haven't had to price in the phase 2 credit cycle downturn. No other market has. They haven't had to. But once they start, then that's when you'll see the bond prices rally. We'll see probably yields break down to, on the 10-year, probably to at least 250. I think 250 is a very reasonable target for 10-year paper. I think you're kind of in no man's land beyond that because, again, I think eventually the market's going to figure out that the Fed's going to, turn the liquidity hose back on, and the inflation genie is not going to get back down to 2, and they might change it to 3. So I think trying to fight from 250 to, let's say 2 or 1.5, I think that's a harder fight to fight from a longer term debt security perspective. But certainly I think from now to 250, 225, I mean, just to set it and forget it. I'm going to have to deal with some volatility between now and then because the economy is still resilient, as evidenced by the housing data, as evidenced by the employment data, as evidenced by the inflation data. But it will stop being resilient in, let's call it, 2 to 3 quarters.
Last question on my end, and everybody here, please make sure you follow Darius Dale and show him support, some love and support here on Twitter, and obviously check out his research in general. With the caveat that I always myself keep going back to this point that nobody can predict the very long term. What do you think the odds are that we're maybe...
Most people can't predict the short term.
No. Although I would argue the short term is far more observable. I mean, there's a lot of studies around that, right? And that goes back to conditions-based mindset. But on the very long term, right? So what would you place the probabilities on the idea that we are in a lost decade? Now, I'm saying that in a dramatic way, but let's face some facts. Emerging markets have had more than a lost decade. Have gone nowhere really since 2010. Bonds, in some cases on the duration side, have essentially had a lost decade on a total return basis. Do you think we might be in something like that in the U.S.?
Lost decade. That's a tough question to answer because there's so many moving parts. Obviously, there's a lot of moving parts, but the number one thing that, like, when I think about trying to forecast the next decade, I think it sort of has to start with how is the regime changing from the previous decade? And I think that the most dominant feature of the previous decade, from my kind of, quantitative economics background standpoint of view, is the fact that inflation persistently surprised to the downside and was persistently below the Fed's target. And that process allowed the Fed to maintain, and other central banks as well, to maintain some pretty radical monetary policy in the context of like long-term human history. If we're going to go back, we're going to study like the 2010s. It's like, holy cow, they actually did that. No wonder, no wonder people moon Tesla and Bitcoin and Dogecoin. Like, of course they did. What else were you to do? I think that in terms of like trying to look forward to the next decade, you got to think about the regime shift from that. And our model saying inflation is going to consistently surprise to the upside, which ultimately means you might have a Fed that goes from perpetually supporting the market at every interval to perpetually kind of like fighting the market at every interval, kind of like how they're doing now, right? And so I think the probability that we see, very kind of, asymptotic asset market performance as a function of like just persistently way too easy monetary policy is much lower on a go forward basis in this decade than it is in the prior decade. And again, I don't have to say things like deglobalization and everything because that's already in the model. I'm trying to break it down to its unit root. And the model is already factoring in things like deglobalization, et cetera, rising commodity prices, et cetera, et cetera. You guys see, I'll actually just tweet out a picture of the model when I'm done with this. But so that model is already, it's already, considering all those factors. And so when I boil it down, it's effectively saying it's going to be a lot harder for the Fed to moon liquidity in the 2020s. And so it's, as a function of that, it's probably going to be a lot harder to see and make risk assets moon the way they did in the previous decade. So I still sense a little bit of a behavioral recency bias amongst investors on Twitter, just looking for any and every opportunity to get back long. I think a lot of folks didn't really buy the 2020 COVID recovery as early as they should have, and I wasn't one of those people. But a lot of folks didn't really get into it as soon as they should have. A lot of folks bought Bitcoin in like March of 2021. And then that was kind of like the highs right before they got shaken out. You know what I mean? I think a lot of folks are kind of looking backwards saying, I didn't make enough money in that time frame. And I want to go back to that. Pomp had a great analogy a couple weeks ago that we all in high school, we have this like phenomenal Range Rover party, or in college, like this all time great party. And we always think about that party whenever we're going out. And it's like, how do we recreate that magic? But the reality is you don't. You just got to deal with the party you have.
This party sucks.
Yeah.
you really ended on a poor note for me. No, but listen, again, everybody, please make sure you follow Darius Dale. Great conversation, Darius. I know your video with Adam Tagart's coming out soon. I'm a big fan of Adam's as well, so I encourage everybody to check that out. It should be on YouTube, I think, tomorrow, right?
Yeah, absolutely. And by the way, I'm not going to tweet it out because I want to make sure everyone who actually participated gets this. The presentation that I go through with Adam Taggart tomorrow actually has that structural inflation model. So just make sure you go not only review that presentation, watch it on YouTube, all that good stuff, but I actually gave him the link so you can download the presentation and go through the materials yourself. The structural inflation models on slide 74. So you'll see that tomorrow.
How many slides are there? 74.
Every month we publish a 100-slide presentation that tries to, kind of help investors understand the full distribution of probable economic outcomes and how they relate to our portfolio construction process.
I'll use a term from the CFA level 4. Well, shit, that's pretty impressive.
I appreciate you, bro.
Yeah, no, thank you for joining. Appreciate it. I'm going to be, believe it or not, on somewhat of a vacation for a few days. So I will hopefully see all of you next week when I resume these spaces. Thank you, Darius. Really appreciate it.
Thank you. Thanks, everyone, for joining. I really appreciate y'all.
Cheers, everybody.